This is video 2, step 2 of how I do my technical analysis when I go to trade, guys. Step 2 is applying the Elliott Wave Principle. Our goals here is to identify basic wave patterns, learn some different wave characteristics, learn some various guidelines for application. I'm going to give you the 3 essential rules of Elliott waves, and we're going to learn how to identify and label the waves, basically, okay? First off, the Elliott Wave Principle is based on Ralph Nelson Elliott's conviction that social or crowd behavior tends to trend and reverse in identifiable patterns or cycles. He identified a number of patterns of movement or waves that reoccurred in combination with larger and or smaller versions of the same patterns. That's where the term or the phrase cycle within cycles comes from. Those who are well versed in the intricacies of these patterns can gauge where the market's recent movements fit into them and can predict where the market will move to complete the cycle. Elliott wave cycle runs on every time frame, including the monthly. Remember, cycles within cycles. We focus on the daily, the 4-hour, and the 1-hour time frames to identify Elliott wave, starting at the beginning of a swing low or swing high point. Knowing the different characteristics of the individual waves will help you identify which wave the market is currently trading within. And again, keep in mind, cycles within cycles. Alright, I'm going to come back to that. 3 essential rules for applying Elliott wave, and there's a few various guidelines that help apply and identify different components of Elliott wave, okay? Alright, the picture on the right basically shows you what a full cycle of Elliott wave looks like in generic terms, I should say, very generic terms, okay? A single cycle of Elliott wave consists of 8 waves. You've got 5-wave impulse followed by the 3-wave corrective, okay? So 1 wave, 2 wave, 3 wave, 4 wave, 5 wave. That's your 5-wave impulse. Wave A, wave B, wave C. That's your 3 corrective waves, all right? These waves are labeled using letters and numbers. Your impulse or motive waves are labeled with the numbers. Those are the trends, okay? Your trending impulse legs are labeled with the numbers, as you see right here. Your retracement or corrective waves are labeled using letters, as you see right here. So this is a trend, this is a retracement or a correction to that market, the retracement. Alright? Now, this whole picture is a complete cycle. Within each wave has certain characteristics that help you identify what wave it is. Okay? The 3 cardinal rules to Elliott wave. Now these are more than just a guideline. These are, these are just merely guidelines, basically, that were proven to have a high success rate and followed even though it's not 100%. Now these 3 rules, guys, stay true more times than not. Alright, and they have variations of them. The first rule is wave 4 cannot enter the price territory of wave 1. If it does, the market's latest move must be a part of a larger motive wave, which could be progressing higher or lower. Wave 2 can't trace more than 100% of wave 1, according to the Market Technicians Association. If it does, then wave 2 might not be a corrective wave as originally thought, and could actually be moving in the direction of a motive wave of a larger degree. Wave 3, which often represents the strongest part of the cycle, can't be the shortest by price compared to either wave 1 or wave 5. Okay, and here's a representative of what that means. Okay, so the first rule, is wave 4 cannot close within the price range of wave 1. From swing low to swing high is wave 1 right here. Wave 4 is this swing to this swing. If this low right here came all the way down here, that's not wave 4. Something else is happening. Alright. Now let's say if the bodies of the candles are closing above or around the structure right here of wave 1, you're still valid. If you have pins below into the structure of price of wave 1, you're still valid. Alright. Wave 2 never retraces more than 100% of wave 1. It can pin below the low of wave 1 to extend that low, but the bodies of the candles should close above the low over here. Now there are a few exceptions. Let's say if you see a nice railroad reversal where you have a nice down bearish movement, which of course clearly that candle closes below that low point. But if it's a reversal, you should see the railroad or an engulfing pull price right back within to that first zone. Okay. Wave 3 cannot be the shortest wave in terms of price movement. So typically wave 3 right here is when a lot of traders hit profit. Okay. And I'll explain that later on as to why. Every wave, impulse, and corrective have their own individual characteristics that help identify them. When applied together with the different guidelines, which we will cover later, identifying waves becomes a little easier. One of the keys to interpreting wave counts is to determine what degree the wave in question represents. Some characteristics of wave 1. Wave 1 is a impulse or motive wave. Wave 1 begins at the bottom of a downtrend and at the top of an uptrend. Okay, it's the very first wave. It's hard to identify as no change in trend is evident, which means you'll have a lot of battling between bulls and bears going on sometimes. Okay, it's less emotional as the prior trend is still in control, and that's what makes it so hard to identify at times. Wave 2 is a retracement or a correction to the trend, which is wave 1. Wave 2 cannot retrace more than wave 1, okay? Even though it can extend the low created by wave 1. Alright. Once you have identified wave 2, or something that will help you identify wave 2 is the guideline of alternation, which we'll cover this later on. Alright. Within wave 2, traders usually continue to sell, so movements are usually steep and sharp. Okay. Wave 2 could also be considered the second half of the W or double bottom. And it usually corrects most of wave 1. Wave 3 characteristics. This is a nice impulse wave. It usually has the largest change from swing low to swing high in terms of price. It's a nice powerful movement. Emotional is most often the longest, deepest, and strongest of the waves. Okay, this is like I said, this is where the most profit is made. The greatest profit potential is in wave 3. Wave 4 is another corrective wave. Okay, This, now that you have, 4 waves, you can apply the guideline of alternation with wave 2. And we'll cover that here in just a few slides. Early traders take profit, others enter long and witness whipsaws. Okay, wave 4s, typically most wave 4s you can see move in a sideways consolidation. Because remember, wave 2 would be more of a steep correction, right? And that's part of a guideline of alternation. The final advance towards either the high or the low is wave 5. What you're looking for in wave 5 is for the testing and failing of either the high and low, depending on the trend. And you're looking for a change in momentum in the opposite direction from the previous trend. If you're using the RSI, the MACD, the TDI, or even the dollar index, you're looking for some type of divergence. After wave 5, you will see the ABC corrective phase, which the ABC corrective phase is going to make it seem like, okay, now you're in a nice downtrend, when in all actuality, it's just a correction to the previous first 5 waves, which create a larger one wave. Okay. Now, when you get into the corrective phases of the market, correction to the market happens after a trend or impulse wave. So after you see the market trending for a while, let's say in an uptrend, the correction is going to trade against that trend. It's going to be a bearish short little trend. Okay. Correction takes place after impulse waves 1, 3, and 5. So wave 2 and 4 are theoretically correctional waves. Okay. The guideline of alternation can also be applied within corrective waves, within your ABC correction. Okay. Typically, there's 3 waves within a correction, and we label those ABC. But if you're caught within a bigger cycle within the cycle, you'll be adding the letters D, E, F, G. Okay. Now that's adding the letters D, E, F, G. This is going to be some more personal, in-depth, continuous education that you'll have to go over. Okay. We'll go over that later. Market will still, on corrective wave A, the market will still be an overall bullish or bearish trend, meaning this is only a correction to the market. You want to look to buy dips on a bull market and look to sell on the uprisings in a bearish market, okay? And if you are buying on, any kind of corrective waves against the trend, keep those to a minimum of an intraday trade or a scalp. All right. If wave A travels in 5 waves, that's part of the cycle within cycles. It will be a deep zigzag. If wave A travels in 3 cycles, it will be a flat or a triangle structure. Okay. So what this means is when you see people on, on Facebook or wherever you follow, and they're drawing, let's say, like a wedge, a triangle, a pennant, or anything like that, you must understand that those market patterns are just retracements of the overall trend. Okay? I mean, how you identify which kind of pattern those are depends on how many waves are within the corrective waves. All right? Wave A sets the tone for wave B in the corrective phase. Wave B is a trap wave of the corrective phase, okay? Traders become euphoric and anxious about continuing the prior trend. It's a good place for a counter trend trade with wave C coming, okay? Because wave C typically is a 3 or 5 wave move that has a lot of movement against the main trend. So basically what wave B will say, let's say if corrective wave A was bearish, wave B, what tends to happen is people will buy at the low of wave A, predicting another impulse wave, when in all actuality it's wave B. Okay? So wave B is going to retrace so much of wave A before it becomes a wave C, which is another heavy bearish move down against the trend. And that's what usually kills people's accounts. Wave C is the killer wave, okay? It wipes out all positions from impulse trends. It's often an extended wave, meaning a 5-wave, okay? A 5-wave C correction. Once it's over, it's time to get back into the market, basically. Wave C is where a lot of the institutions will place their trades, okay? This is where the smart money is made. This is where the smart money is placing their orders, okay? Elliott Wave is tied in with Fibonacci by the ratios. All right. We'll go deep into Fibonacci later, but here's a little bit, some basics of it. Fibonacci ratio of 0.618 was made famous by a 13th century mathematician named Leonardo Fibonacci of Pisa. What Fibonacci does, it takes the sum of two numbers based on a number sequence, adjacent numbers from the next higher number. I totally read that wrong. The sum of two based on a number sequence adjacent numbers forms the next higher number. What that means is if you take 1 plus 1, that should equal 2. If you take 1 plus 2, that should equal 3. 2 plus 3 equals 5. 3 plus 5 equals 8, and so forth. The 618 ratio is often referred to as a golden or divine ratio because it has been found throughout nature, such as in the breeding pattern of rabbits, our own DNA double helix. It's found in how petals on a flower are arranged, portions of the human body, a galaxy spiral, and so on ad infinitum. Basically, Fibonacci is found throughout nature, throughout life, throughout the world, throughout building, architecture, you name it. Fibonacci is an underlying key element in all that, okay? The 5 waves of a motor phase have a Fibonacci relationship with the 8 waves of a complete cycle. The cycles within cycle, okay? Basically, what that means is depending on the trend or how much movement a wave has, the retracement is only going to recover so much. Each wave or phase tends to have a Fibonacci relationship with other waves or phases. Thus, a retracement phase is often close to the 382, or let me rephrase that. A retracement phase usually happens between the ratio of 382 and up to the 786 ratio, the length of the motor phase. All right, and we'll go into detail on this later, guys. All right, so here's some guidelines for application when you apply the Elliott wave. Now remember, a guideline is not a hard or fast rule that can't be broken. It is simply a tendency, something that happens so often that it can almost qualify as a rule, except for the times it doesn't work as expected. Now that key piece right there is something to really remember and to really hone in on, because even though, like I said, I'm teaching you guys the strategy I use to trade, okay? Even though, let's say you have all the confluences or the perfect setup, it may seem like, it can still go against you guys. Remember that. You can still see and have all the confluence there, all the perfect whatever. It can still go against you. All right? The guidelines are always useful. The guidelines are useful ways for applying Elliott wave analysis that have shown their validity over time. But again, they are not rules. They may not work out every time. Okay? The first guideline, which can help you identify some waves, is the guideline of equality. Basically, this says that two of the modal subwaves in a 5-wave sequence will tend towards equality in price, and is generally true of non-extended waves. This means that when wave 3 of an impulse wave is the extended wave, which it typically is, wave 5 will approximately equal wave 1 in price. This is useful for potentially projecting the end of wave 5 in an impulse if you recognize wave 3 as the extended wave. So let's say this is on the charts, guys, right? And this is all we see is this retracement right here. We don't have wave 5. What you could do is take your trend line, draw from swing low, swing high, copy, paste it at the end of this retracement right here, wave 4 retracement, and it should give you a 1-to-1 ratio and a nice projection as to where wave 5 should, or the area or zone where wave 5 is expected to end. And that's the guideline of equality. The guideline of alternation within an impulse wave. Okay, this is the guideline of alternation within an impulse wave. This says that the forms of wave 2 and wave 4 will alternate. If wave 2 is a sharp style correction, wave 4 will tend to trade sideways in a consolidation. If wave 2 is a consolidation or a sideways correction, wave 4 will be a sharp and steep correction. Okay. Now this is useful for anticipating the end of a wave 4 correction within a suspected impulse. Again, let's say wave 1, right? We usually expect wave 2 to be that steep correction. This forms that double bottom or so, or whatever you want to call it, right? But that doesn't always have to be true. More times than not, I think I've seen it be more steep than sideways. Okay? But nonetheless, if wave 2 is steep, wave 4 is going to be flat. If wave 2 is flat, wave 4 should be more steep. And that's the guideline of alternation within the impulse wave. The guideline of alternation within a corrective wave says that the forms of wave A and B will alternate within a 3-wave correction. So what that says is, if wave A is a flat type correction, wave B may be a zigzag type of correction and vice versa. If wave A is a zigzag, wave B is going to be a flat. It also states that if the correction begins with the more simple wave for wave A, expect the following waves B and C to be more complex or more extended waves. The guideline of depth of corrective waves. What this says is, when the market goes into a correction, it will often correct the territory of the previous wave 4 of a lesser degree. Alright. This does not necessarily mean it will reach the bottom of the previous 4th wave, but rather that we should expect it to reach the span of the previous wave 4 of a lesser degree. It's often a good place for a market to find support or resistance before the trend moves on. Alright, so what this means is, here's your wave 4 right here, a corrective wave. Okay, remember, this is a motive phase or impulse phase. This is your retracement. So from this whole retracement, upon the ending of wave C, the end of wave C basically should end at or above the low of wave 4. Okay, that's what the guideline of depth of corrective waves is saying. All right. A short Elliott wave summary. We've identified impulse and corrective waves. I've given you some characteristics and properties of each wave, and we've applied some various guidelines to identify the different waves. And again, guys, things I'm teaching you in these first several videos of the training, this is your foundation, okay? We will be doing more in-depth lessons later on, but for now, I need to get you all a general understanding of the basic concepts, or in the foundation. I need to get that that's solidified basically. Okay, so there's a hell of a lot more information on Elliott Wave to cover than what I've covered. Okay, that's just the basics, guys. Let's see if we can find something or apply the Elliott Wave on the chart now. Alright, here you can see where we left off from applying the quarters theory. Okay. Next step is applying the Elliott Wave Principle. And you begin that either on the daily or the 4-hour chart. Okay. Typically, I like to look at it on the 4-hour. And sometimes you'll have to, zoom out or just take a scroll through the market to find some history points and so forth before you can even begin to apply it. All right. Right now, what I'm going to do is try to find the perfect example for you. So give me just a second. Let's see. Actually, I believe a perfect example on the day. Hold on. Okay. Looking at the daily chart on Euro USD, I'm going to give you an example of what Elliott looks like, okay? So, looking at from here, looking at within this box right here, guys, okay? I'm going to show you the guideline of alternation within the impulse waves. I'll show you some cycles within cycles, and I'll show you the first 5 waves, okay? This is another reason why I like using TradingView, because it actually has that the drawing tools that I need. So you would take this low, so here's your wave 1, your trend of wave 1. Wave 2, sideways consolidation, right? Wave 3 isn't the shortest wave. From this low to this impulse high isn't the shortest wave. Wave 1 is the shortest wave, so that guideline still applies. Wave 4, guideline of alternation, right? Wave 2 was sideways consolidation, so wave 4 was a steep correction. Guideline of alternation. Wave 5 is your extended wave, guys. On an extended wave, what that means is you usually have another 5-wave sequence with the correction to complete that one wave. So you've got, let's see if we can do this. Let's see. Wave 1, steep correction. Wave 3, kind of a sideways correction. Wave 5. Now that is a cycle within cycle. Actually, let me mark it up for you. That's what cycles within cycles means. Now, even within this leg right here, you have more cycles within cycles, guys. Oops. So this is what you must become proficient in as far as identifying the different waves by just applying those mere basics I had just taught you in the previous section, okay, of Elliott Wave. And this is what you would do to mark up your impulse waves if you wanted to. Now, you don't have to mark up each of the cycles like I did. As long as you have the main cycle and you have that understanding, you should still be able to know and understand that, hey, here's a wave 5. You're still looking to short. Here's a mid-range. Here's the morning star, shooting star, right? So now you've got 3 confluences. You've got your mid-range. You've got the price action of the candles. You've got the psychology of the market, understanding that this was a 5th wave that's completed. That's 3 confluences right there that help boost your chances of winning a trade right there if you short it. Okay? So if you took a short right here, this is on the daily chart. If you took the short right here, you're now understanding that, hey, this might be a corrective phase, right? So here's the correction phase. You could have done it like this. Which is what I would have done. Because keep in mind the quarters theory says whatever quarter point is denied, since the price didn't break above this quarter point, it's rejected. The next target, it targets the quarter point previous, right? And that's exactly what it did. So you now have a target as to where the market should correct to, right? Not only that, the depth of corrective waves. Look where wave C is ending in comparison to wave 4, right? So even another thing, even within the corrective phase, you still have the cycles within the cycles. Okay? Wave 1, here's a little bit of a steep correction with this candle right here. Wave 3, sideways consolidation. So this is something that, guys, it takes a little bit of time to train your eyes to see and recognize. But if you can understand and remember just a few of the concepts when applying Elliott Wave after you apply the quarters theory, it's going to enhance and increase your profitability when you're trading the markets, okay? Let's get that off of there. Sometimes you're not going to be able to identify Elliott Wave. Like, this is something that takes practice to identify, guys, okay? So just keep that in mind. It takes practice. Let's say if you're not able to identify Elliott Wave on the 4-hour or the chart you want to, click on the chart to the left until you find something that you're able to identify. Excuse me. Let's see what the 1-hour offers. Let's see here. it's not offering too much to identify just yet that I can readily train you guys on. Let's try a different chart. All right, so looking at the Euro USD, what I would label this as so this fifth wave right here, I don't believe it's done just yet. So, but that's how I would label the Elliott wave on this one. You've got a steep correction right here. You've got more of a sideways correction right here for wave 4. And that's what helped me identify this Elliott wave cycle right here. I'm expecting the euro to pop up a little bit, which goes in line with 5 wave right here. So the 5 wave isn't complete just yet, right? I can't put this 5 wave down here just yet, but this is a projection as far as what am I expecting to happen in the market, okay? That's basically the basics of Elliott wave. Like I said, we've got a plethora of information to cover in regards to Elliott wave, guys, and that's just going to be some continuous education stuff. Like I said, I need to get you guys solid in understanding the basic foundations of the various concepts first, okay? Now that we finish this video, we'll move on to video 3.